Well, hello and welcome back to Principles of Accounting 2. I'm your host, Dr. B. We're going to be continuing our discussion on budgeting. But this time, we're going to talk about the different types of budgeting approaches. And we're also going to talk about a very important concept called variances. The word variance simply means the difference. The difference. That's what the word variance means. The difference. When we talk about the variances, it'll be from the perspective of the actual cost versus the budgeted cost. And those are the kind of variances we'll be talking about when we talk about budgeting. So let's take a look at the different types of budgeting approaches. And we'll talk about the variances and we'll talk about flexibility, fixed and variable cost, all those good things. So there are two methods to budgeting that companies choose. You can either have a flexible budget or a fixed budget. A fixed budget is a budget that does not change. It's static. It's fixed. The budget does not change. We say, and it's usually for 12 months, and we'll say, hey, for the year 2023, here's what we expect to sell each month. Here are all our expenses for each month. And that's it. Okay, the budget will not change. Say, hey, here it is. You either hit it or you don't. That's a fixed budget. It's what we call static. And there's only a few types of organizations that use a fixed budget. Primarily, the government, the federal government, the state government, the city government, the local agencies within those governments. They all use fixed budgets. Why? Because of the process that they go through for budgeting. They're fixed. Here's the amount you got. Okay, now you got to use it, right? That's fixed. You're not going to get more, you're not going to get less, you're getting what you get, right? It's fixed. So governments, nonprofits, they usually use a fixed budget. So governments, nonprofits, and there's probably a few, of course, like utility companies, fixed budget. Those kinds of organizations, they have fixed budgets. Everyone else typically uses a flexible budget. A flexible budget has the ability to have variation. And it's based off of the potential for different levels of sales. And here's what I mean by that. I'll give you a range, okay? A range. 80,000 units is usually a slow month. 100,000 units, that's a busy month. 80,000 units, slow month. 100,000 units, busy month. We call that a low and a high. Okay? And usually there's a medium in between, right? Low, medium, high. Those are my levels of sales. Okay? And based on those levels of sales, I can adjust my budget based off of where I think I'm going to sell. So I can budget for low, medium, and high for each month, and I can adjust the rest of the budget based off of those levels. That's what's called a flexible budget. I can adjust down, I can adjust up, and it's based off of the expectations, right? Flexible budgets are nice because we have the ability to adjust based off of those percentages or those levels of changes in sales. That's why most companies use a flexible budget because it allows it to be more dynamic. A flexible budget, it can be called a variable budget, but most of the time it's called a dynamic budget. Flexible is dynamic. Here is an example of a fixed budget. Remember, the fixed budget does not change. Okay? Regardless of what actually happens, does not change. Regardless of what actually happens. Fixed. It's fixed. Now, when a budget is fixed, the actual results are going to typically be different than the fixed amount. Now, here we go. For example, I budgeted my sales for 10,000 units. I actually sold 12. Okay? Budgeted for 10, actually sold 12. Now, that's good and bad. It's good because my sales were higher than what I budgeted for. That's nice. Okay, we see where the variance is. Remember, the word variance means difference. And here's how I figure my variance. I take my actual minus the budget. Actual minus the budget. Actual minus the budget will give me my variance, my difference. Actual minus the budget. So 125,000 actual sales, 100,000 budgeted sales gives me a variance of 25,000. Now you see the little letters next to the amount, right? I'm sorry. I almost said that very inappropriately and I started laughing after I said it. F means favorable. Okay? F means favorable. When something is favorable, that means the business likes when it happens. Okay? It's a good thing. Favorable. When my sales are, if my actual sales are higher than my budgeted sales, that's favorable. I like that. So $25,000 favorable variance, favorable difference. I like having 25,000 more in sales. That's favorable. Makes sense so far? Yeah? Favorable.
Yes.
Okay, awesome. Now, let's get down into the costs. Direct materials. Actual, 13,000. Budget, 10,000. Actual minus budget. That variance is $3,000 you. Unfavorable. Unfavorable. That's no bueno. That's not good. Okay? $3,000 unfavorable. Why unfavorable? It's a cost. If my cost is higher than my budgeted amount, that's not good. So if my actual cost is higher than my budgeted cost, not good. Unfavorable. Okay? That's why you see the unfavorable next to most of the cost if the actual cost was higher than the budgeted amount. So that's why you see unfavorable. The total expenses, actual 99,600, budget 88,000. That is an unfavorable of 11,600 total expenses. Ooh, that hurts. But income from operations, also known as net income, 25,400 actual. Budgeted 12,000. That's good. That means I got more income based on the actual results than I had budgeted for. 25,400 minus 12,000, 13,400, favorable. So all of this to say, when your actual sales are greater than the budgeted sales, that's favorable. But if your actual expenses are higher than your budgeted expenses, that's not favorable. But when you add everything up, in the income from operations area, we find that the income from operations is greater than the budgeted amount. That's good. That's favorable. Make sense? This is where that variance comes in. Awesome. Thank you, Nikki. Very cool. So that's the fixed budget. Now let's talk about the flexible version of the budget. I like flexible budgets. And the reason why I like flexible budgets is because it minimizes the possibility of having unfavorable variances. Again, the reason why I like flexible budgets is because it minimizes the possibility of having unfavorable variances. It still shows the difference in the actual versus the budgeted amount, but the difference is based off of the levels of activity. And I'm going to show you what that looks like here. Flexible. Let me break it down a little further. Flexibility based off of the level of activity. If I remember, low, medium, high. Low, 80,000 units. Medium, 90,000 units. High, 100,000 units. I sometimes might sell as low as 80,000, as high as 100,000. It's based off of my capacity. Remember, capacity is the amount of units I could potentially make up to 100%. Capacity. That's how I come up with those low, medium, high, right? Capacity. I have the ability to be flexible in my budget based off those ranges, low, medium, high, or levels of activity, I should say, low, medium, high. It's important to note the behavior of the variable and fixed costs associated with the levels of activity. As you know, and we've talked about this several times, the total variable cost will change with the change in the level of activity. The more I make, the higher my variable costs are. We know that. You know that. We've talked about it so many times. Fixed costs, however, we know will remain the same regardless of the level of activity. The rent amount, still the same. Salaries, still the same. The depreciation, still the same. Those are fixed costs. Variable costs are direct materials, direct labor, factory overhead, variable factory overhead that change with the level of production. And so it's important to understand that we budget both fixed and variable expenses within our flexible budget. So this is an example of a flexible budget. Think of it low, medium, high. Okay, low, medium, high. These are my my levels of activity. Low, medium, high. Low, 10,000 units. Medium, 12,000 units. High, 14,000 units. Low, medium, high. So we have all of the variable cost per unit times the number of units I expect to sell. And so I can estimate all my variable costs based on each level of activity. That's what makes it flexible, right? And then I have my fixed costs. The fixed costs, remember, fixed costs don't change regardless of the level of activity. So those will be the same for low, medium, and high. For low, medium, high, we know that the variable cost will change based off of the number of units being produced. Make sense? No good so far.
Yes.
Awesome. Thank you.
Yes, sir.
Thanks, Mike. Appreciate it. Okay. I think of it as low, medium, high. I mean, that's that's like the best way of thinking about the flexible budgets in terms of levels of production or levels of activity. And earlier I had said the reason why I like the flexible budget the most is because it minimizes the variances. And based off of that, I can adjust my flexible budget to match my actual performance. And so we see that in this example below, where the actual results are closer to the actual number of units that were produced. And we still led to some variances, $5,000 variance in sales, favorable. I came a little under, little over in terms of variable costs. Contribution margin overall was favorable. My fixed costs, those were all pretty much the same, except for insurance expense. The insurance went up a little bit. Didn't expect it to go up, but it did for whatever reason. So that part was unfavorable. But overall, we can see a favorable variance of $3,000. It's a similar process to the static approach to budgeting, but again, the flexible budgeting process allows for a minimization of variances. Now, when talking about variances, we know that variances are the difference between the actual performance minus the budgeted performance. Actual minus budget is the variance amount. But in order for us to find the variance and to be able to understand it, we also need to understand this thing called standard cost. And I want you to think of standard cost as being the budgeted cost. Word standard cost, when you hear standard cost, think budgeted cost. The standard cost is the budgeted cost. Standard costs are very, sometimes they're predetermined. Standard costs are set by the expectations. What do I mean by that? Well, I normally purchase 10,000 units. That's my standard. I normally purchase 10,000 units. That's my standard. I normally pay $10 per unit. That's my standard. I normally, we hear the word normal, right? Normal, standard. I normally purchase 10,000 units at $10 per unit. That's my standard cost. That's what I normally pay. Right? I think of standard cost as being the budgeted amount. And that's the best way to think about this. Now, there are standards for price and quantity when we talk about direct materials. There are standards for labor when we talk about the average hourly rate and the amount of time it takes to make a single unit. Average hourly rate, average amount of time to make a single unit. These are the standards for labor. Now we also have standards for overhead. Standard hourly rate for overhead and a standard activity base, number of hours, whatever. But those are the standards. That's what the word standard I think of like as being normal or the budgeted amount, standard. Here's an example of standard costs for materials, labor, and overhead. We have a company here. They make baseball bats. I like baseball. In fact, I'm going to go to a Orioles game on Saturday. Very excited about that. Anyway, so our company makes baseball bats. And so I have standard costs to make a single baseball bat. And here's how it works. The standard quantity to make a single baseball bat is 1 kilogram of wood. And the average cost, standard cost per kilogram of wood is $25. That's like the average market price. So yeah, $25 per kilogram of wood, great. On average, it takes me 2 hours to make a baseball bat at $20 per hour. So that's a total direct labor cost average of $40 per baseball bat. And I have a factory overhead rate of $10 per labor hour. Labor hour is my base, my activity base. So 2 labor hours times the $10 per hour is $20 for overhead. So we add direct materials plus direct labor plus factory overhead, giving me a standard cost of $85 per baseball bat. Again, the standards are what I expect. They're the standard. They're the expectation. They're the budget. But of course, we know in life that the standard's not always going to be the actual. I'm going to have employees that are going to make more than $12 an hour. Sometimes it might take me more than $2 hours to make a baseball bat. Sometimes I might pay more for wood because the cost of wood went up. These create what we call cost variances. It's the difference between the actual and the standard cost. It's very straightforward to understand. If the actual cost is greater than the standard cost, we call that unfavorable. You spend too much money. It's unfavorable, yeah? But also, if the actual cost is less than the standard cost, that's favorable. Hey, you save some money. That's good. So unfavorable, you spend too much. Actual greater than the standard. Favorable is when the standard is actually going to be greater than the actual. So actual cost is less than the standard cost. That's great. That means you save some money. That's favorable. So unfavorable, favorable. As managers, it's important that we understand the variances, the actual minus the standard. And the reason why it's important that we understand this is because we as managers need to take action in order to control our costs. You remember we had the conversation about controllable costs and uncontrollable costs. Controllable costs are the costs that we as managers can control. They're within our power. Uncontrollable are things that are outside our area, right? But controllable costs are things like direct materials, direct labor, factory overhead. Those are things that we can control to some degree. And so, as managers, we need to understand our variances because that is an indicator of a potential issue that we can then take action on. So the process is we prepare the variance reports, analyze the information, and have some questions and answers, and then take action. based off of the variances that exist. Now, here we go. This is where it gets a little, hey, So, take your time, take some notes here, okay? This part's super important. This formula looks a little confusing, right? So it gets a little muddy, but understanding the variances is so important. So being able to calculate them is also very important. So remember, the variance is the difference between the actual and the standard cost. Actual cost minus standard cost is your cost variance. But first you need to know how to calculate the actual cost and the standard cost. So step one, calculate the actual cost. The actual cost is we take the actual quantity times the actual price. Actual quantity times actual price is how we find the actual cost. So actual cost is the actual quantity times the actual price. That's step one, find the actual cost. Step two is find the standard cost. Standard cost is the standard quantity times the standard price. Again, standard cost is the standard quantity times the standard price. That's step two. First, find the actual cost, then find the standard cost. And then, of course, the third step is take the actual cost minus the standard cost. So think of like those little parentheses where the multiplication parts are. Do those first. Do those first. So actual quantity, that's what we actually purchased. The actual amount of materials we purchased, that's the actual quantity. The standard quantity is what we normally purchase. The actual price, that's how much I actually paid. And the standard price is what it normally is, the standard price. Okay, materials and labor. There are differences in materials and labor. We call these variances. The differences stem from what we actually purchased in terms of materials or the actual amount of hours worked for labor in comparison to the standard quantity we normally purchase or the standard number of hours actually worked. So this, the formula gets a little confusing at this point, right? This focuses on the differences between the materials and the labor. This slide, this part makes it a little confusing, so I want to show you the next slide, which I think breaks it down a little bit easier for us to understand. So remember when I first talked about variance, it's the actual minus the standard. Now within there, we take the actual quantity times the actual price to find the actual part, right? Minus the standard, which is the standard quantity times the standard price. There are two other variances you need to find. First is called the price variance. That's the difference in price, actual price minus the standard price. There's a certain way to go about that. We take the actual quantity times the actual price minus the actual quantity times the standard price. That gives us the price variance. Remember the little parentheses. You do the multiplication first. Okay? Then you do the addition and subtraction. So actual quantity times actual price minus actual quantity times standard price will give us the price variance. We also need to find the quantity variance, the difference in quantity. To do that, we take the actual quantity times the standard price minus the standard quantity times the standard price. That will give us the quantity variance. The price variance and the quantity variance. These together will give us the cost variance. To simplify the formulas, for price variance, we take the actual price minus the standard price. Do that first. Remember the parentheses. Actual price minus the standard price times the actual quantity. That will give you the price variance. Remember, I'm trying to simplify. Simplify this crazy formula we got up on top with all these multiplications and subtractions and all that just simplify. Probably in one of your math courses, you probably learned with like fractions. You know, it's like, oh, the common denominator thing, and then they cancel out. That's very similar to what we're doing here. So to find the variances, use the formulas down below. So for price variances, actual price minus the standard price times the actual quantity. That will give you the price variance. For the quantity variance, take the actual quantity minus the standard quantity times the standard price. That will get you the quantity variance. Does it make sense, or did I lose everyone like entirely?
I'm definitely gonna have to go back over it.
Thanks for your honesty, Mike. I appreciate that.
I think the last two slides, it kind of seemed like I was getting a solid grip of it, but now I probably have nothing.
Yeah, I know. It gets confusing when we get into the variances. That's what throws everyone off. So let me try to simplify it even further. So when we first started our conversation on variances, and I'm just going to go back a little further. We talked about this simple formula up here. To find the cost variance. To find the cost variance, first we find the actual cost and the standard cost. The actual cost is the actual quantity times the actual price. It's pretty straightforward. We got the actual cost from doing that. Quantity times price, guess what? You get the cost. Actual cost. Minus the standard cost. Remember, the standard is like your budget amount. Budgeted quantity times the budgeted price, basically, right? That's how you find your standard. Standard quantity times standard price. So now we found our actual cost minus the standard cost gives us the cost variance. Within the cost variance, there are two other variances. Within the cost variance, there are two other variances. One is called a price variance, and the other is called the quantity variance. Now, the word variance means difference. With the price variance, it's the difference between the actual price and the standard price. With the quantity variance, it's the difference between the actual quantity and the standard quantity. Remember the law of common denominators here, because sometimes they'll get canceled out. To show you how to find the price variance and the quantity variances, we've simplified it here. But to simplify it further, to find the price variance and the quantity variance, we use this formula down here. So the actual price minus the standard price, do that first, then multiply that by the actual quantity to find the price variance. To find the quantity variance, we take the actual quantity minus the standard quantity, and then we multiply that by the standard price. So to recap, the cost variance has two other variances within the cost variance, and those are price variance and the quantity variance. Price variance is the actual price minus the standard price. Now we multiply that by the average quantity. The actual quantity. And then the quantity variance is the actual quantity minus the standard quantity. And then we multiply that by the standard price. Does that help to kind of clarify this mess of slides? Or are we still lost? Nakia.
I was gonna say it's starting to clear up a little bit for me.
Okay, well, that's good. I'm happy to hear that. That makes me feel a little bit better.
Thank you.
I know some of the slides are a little muddy. Too many things going on. How's everyone else feeling? We're okay so far. Feeling better. Mike,
Better.
I could use one review.
what's that? I'm sorry?
I'm sorry, I could use another review. I mean, on my own is what I meant.
Okay, I got you. Mike?
Definitely better, but I agree with the last person. I'm definitely gonna have to go over this again.
Okay, cool. All right, good. Well, at least we're getting there. Important. Okay, so remember, within the cost variance, there are two other variances. There's a price variance, price difference, and the quantity variance, quantity difference. Now, of course, there are other variances to be concerned about. There's what we call materials variance and labor variance. And remember, the word variance simply means the difference between the actual and the standard. First, let's talk about materials variance. We have some information for our example. Now we're a company, we make golf club heads. It's the big part of the golf club they use to hit the ball, right? So here's how it works. We take some metal, we make a golf ball, a golf club head. So we have direct materials. We use about a half a pound of metal at about $20 per pound. That gives me a direct materials cost of $10. Half pound, so 0.5 times 20 is $10. And it takes me about an hour to make one golf club. That's $16 per hour. That gives me direct labor of 16. That means my total standard direct cost is $26. Standard direct cost is $26. The keyword here is standard. Standard, remember, that's a budgeted amount. That's what I normally pay. So we're talking about materials. Sometimes the cost of materials, in this case metal, changes. It goes up, it goes down. Now I have to buy my metal from this one company, and sometimes they charge me more, sometimes they charge me less. So I need to find the variance. My standard, remember, my standard, what I normally pay, is $20 a pound. Okay? So, I normally pay $20 a pound. So my standard's on the right-hand side, okay? On the right-hand side, I normally pay $20 a pound, and I normally buy 1,750 pounds of metal to make a lot of golf clubs for the year, to make 3,500 golf clubs. I normally make 3,500 golf clubs each year, and each golf club requires half a pound of metal, which means I normally purchase 1,750 pounds per year. And the standard price per pound is $20. That means I normally, standard, pay $35,000 for my materials. So in some cases, my actual quantity might be higher or lower, and my actual price might be higher or lower. Okay? Because, sometimes I need to order a few more pounds, or the price per pound goes up, right? So I make a phone call and I say, hey, supplier, I need to purchase my standard amount. And he goes, hey, yeah, I can't do that, but I can round up to 1,800 pounds. So it's okay. So 1,800 pounds is what I actually ordered. I budgeted for 1,750 pounds, but I actually got 1,800 pounds. And it turns out the price went up to $21 per pound. So my actual cost is $37,800. This leads us to a variance. Okay. The variance, remember, it's the difference between the actual and the standard. And I have a quantity variance and I have a price variance. The quantity variance, it is 50 pounds. Actual 1,800, standard 1,750. So my quantity variance is 50 pounds. Actual minus standard. My price variance is $1. I got it for 21. I normally pay 20. So my price variance is $1 per pound, and my quantity variance is 50 pounds. So I take my actual quantity times my standard price to find the variance. Actual quantity, purchase 1,800 pounds. My standard price, $20 per pound, gives me 36,000. To find the price variance, I take the actual cost, 37,800, minus the variance to find the price variance. 1,800 is my variance. And that's unfavorable. The reason why it's unfavorable is because, again, my actual was greater than my standard. And I can find the quantity variance. Actual quantity, standard quantity. I take my variance, 36,000, minus my standard, 35,000. Gives me a quantity variance of $1,000. And again, that's unfavorable because the actual came in greater than the standard. Make sense?
Yes, sir.
Yes,
All
sir.
right, we're getting there. We're getting there. All right, so that's materials. My total materials variance is 2,800. Why 2,800? Remember, price and quantity together gives me total direct materials variance. So 2,800. Still unfavorable because it's the actual is greater than the standard. Why do managers do this, right? Why do we go through this exercise of variances? It's all about controllable costs. Who's responsible for it? Who's responsible for controlling the cost? Why did this cost difference occur? We analyze it, and then we try to make a decision and how to control it. Right? That's why we go through these exercises. And I do the same thing for labor. Uh, labor labor follows the same principle. We have actual cost of labor and the standard cost of labor. Actual cost is actual hours times actual rate. Standard cost is standard hours times the standard rate. The variance is actual hours times the standard rate. Within labor actual and standard cost variances, I have two new variances, two other variances. One is called a rate variance. That's the difference in the actual dollars per hour. And I have what they call an efficiency variance. That's the difference in the actual hours. So rate variance, difference in rate. Efficiency variance, difference in hours. And the formulas for those are actual hours times the actual rate minus the standard rate to get the rate variance. For the efficiency variance, number of hours, it's the standard rate times actual hours minus standard hours. And that will get us the rate variance and the efficiency variance. Efficiency is a fancy word for difference in hours. Going back to my example, golf club head company. Okay, we're hardworking people. We work 3,400 hours. On average, my employees make $16.50 per hour. Okay, so direct materials. Half a pound of metal per golf club head, $20 per pound. Direct materials cost $10. Direct labor, an hour to make one golf club head at $16 per hour. Total standard cost $26 per golf club head. There are differences in labor. You know this. Sometimes my employees make more. Sometimes they make less. Sometimes they can do it faster or slower. Right? It's the differences. So remember our standard cost, 3,500 hours per year times $16 per hour gives me a standard cost of $56,000 for labor. My actual cost, I actually did it in less time, 3,400 hours, but paid my employees a little bit more, $16.50 per hour. Gives me an actual cost of $56,100. It's looking unfavorable. Okay. But the actual rate, the actual hours, that's favorable. But the actual rate, unfavorable. The variance is actual hours times the standard rate. Actual times the standard is variance. Actual hours, 3,400. At standard rate, $16, giving us a variance, 54,400. The rate variance, unfavorable. Of course it is. 1650 versus 16. That's unfavorable by $1,700. My actual hours, efficiency, that's favorable. Why? Because it took me 100 hours less to manufacture 3,500 golf clubs. So it's the variance, the standard minus the variance, actual minus the variance, we get the rate variance and the efficiency variance. Good so far. We're almost done. I know, it's a lot of variances. All right. Total cost variance, $100. Still unfavorable because the actual is greater than the standard. Why does it happen? Sometimes I hire better employees. They're more skilled, so I have to pay them more. That will result in an unfavorable rate variance. However, those more skilled employees will do the same work in less time, so that will lead to an efficiency variance that is favorable. It's important that managers understand this because, again, it's about controlling costs, which are for employees, it's related to training, supervision, etc. So we talked about materials variances, we talked about labor variances, and now, of course, you guessed it, we're going to talk about overhead variances. Overhead variances are the differences in overhead cost. Oftentimes, and we talked about this before, the overhead rate is usually predetermined. Call it a predetermined overhead rate, and it's assigned based off of an activity base, which is usually, the activity base is usually labor hours, very standard. So we take the total overhead cost divided by the activity base, which is like number of hours. To assign the overhead cost, we take the predetermined overhead rate that we found from step one, we multiply that by the standard activity, standard hours. Step one, to find the standard overhead rate, is we determine the allocation base. It's usually like the number of hours it takes to manufacture 3,500 golf ball or golf clubs. 3,500. That would be our allocation. Step two, choose a predicted activity level. How many units? Step three, compute the standard overhead rate. And here's an example of this. This is using a flexible budget to find the overhead rates. And so we can see that it's based off of the capacity, 70%, 80%, 90%, 100%. Remember, capacity is how much I can produce. You know, that's my limits, right? Capacity. I go all the way up to 100%. And this kind of shows it from that example, what predetermined overhead rates are. It's total factory overhead divided by the direct labor hours. That is the base, activity base. So budgeted total factory overhead divided by the activity base, number of hours, typically. That'll give you the predetermined overhead rate per hour at each level of output. To find the cost variances in overhead, it's simply very simple. The actual overhead incurred, actual overhead, minus the standard overhead. Pretty simple. I wish they were all that easy. Actual overhead minus the standard overhead. So looking at our example, number of hours, actual was 77,650. The standard was 7,000. Unfavorable variance, $650. Actual minus the standard. Yeah, overhead is pretty straightforward. It's actual minus the standard. And of course, there's two other variances within it, controllable variance and volume variance, but it works the same exact way. Actual minus the standard. Actual minus the standard. Okay, so controllable variance, actual minus the standard gives us the variance. Overhead volume variance, actual, or I'm sorry, the budgeted minus the applied gives us the variance. And of course, there's a sales variance. You can't go without a sales variance, right? Especially when we're talking about budgeting earlier. Actual minus the budgeted, sales variance. Yep, actual minus standard, which is your sales variance, or the budget. Of course, it gets a little more complex than that if you really wanted to. And looking at the variances, for overhead, we have variable factory overhead and fixed factory overhead. We can look at the variances for things like spending, efficiency, volume, and controllable variances. Actual minus the applied to get your variable overhead variance. Actual minus applied. See a recurring theme. It's the formula is basically the same for all the variances. It's just how it's broken down. Same with variable overhead variances. Actual minus the applied. Actual minus the applied. Fixed overhead variance, actual minus the applied. You can find the same for spending variance and volume variances, actual minus the applied. Actual fixed minus applied fixed, then find the fixed overhead variance. Actual minus the applied. We can do this graphically. Nice little graphic. Actual minus the applied. Here's a nice summary chart. Nice summary chart. And of course, there's some journal entries. At the end of the respective year or respective month, when we have variances, we have to document them in the accounting system through journal entries. And the way we do that is by debiting the respective work in process account to increase work in process by those variance amounts, and crediting the actual cost for raw materials should there be a variance in materials. And we would do the same thing for labor. For labor variances, we would debit work in process, debit the variance, and then credit the efficiency variance and credit factory wages payable, the actual cost. And of course, we would make similar journal entries for differences in volume and factory overhead. We would debit work in process, debit the variances, and credit factory overhead. And of course, this is a summary of the income statement, the budgeted income statement. And then, of course, we could apply the variances there as well. And that, my friends, is the end of a very grueling chapter on budgets and variances. And you're probably going to look at me and say, man, I don't know what he was talking about with the variances, but the good news is, besides, of course, the homework assignment for chapter 23, the chances of you seeing variances again after that, you might have like 1 or 2 questions about it on the final exam. But I promise you it's not difficult. The biggest takeaway here is that you take the actual amount minus the standard amount. And that's really how you find the variances. It's in the simplest form. Any comments, questions, or concerns?
No, sir.
Awesome. Thanks, Mike. Okay. I want to quickly remind you what's going on. We are in Module 3, Week 5, Chapters 22 and 23. For this Sunday night, you have a Chapter 22 homework and a Chapter 23 quiz. As a reminder, you can take all homework assignments and quizzes 2 times. I will accept the higher of the 2 grades. Right? So 2 times, 2 attempts for each homework assignment and each quiz. 2 times, right? I'll accept the highest of the 2 grades. Please make sure that you complete your homework assignment and quiz on time, please, on time. So it's due by this Sunday night. I will expect to see your Chapter 22 homework and your Chapter 23 quiz in the gradebook by this Sunday night, please. I recommend that you work early. Each of them have 5 questions. That part's not bad. It's mixed true, false, multiple choice as it normally is. But just, take your time with it. And remember you have that second attempt if you're not satisfied with the first go around. My other recommendation is to try the exercises. Chapter 22 exercises. I didn't get one for Chapter 23. The variance ones are actually, believe it or not, hard to find. But the Chapter 22 exercises will help. And then, of course, our discussion tonight and anything else that you might find helpful. If you have any comments, questions, or concerns, or you have more questions about variances, you can always email me, call me, set up office hours, whatever it takes. I'm here for you 100%. Remember that our course does have tutoring available with Professor Remming. Happy to help you out with tutoring. The office hours link, if you want to set up office hours with me, are right here. If you want to set up tutoring, select this link. And of course, you can always email me or whatever you need. And so I want to say thank you all so very much for your time today. You did great on the midterm exam. As we get closer to the final, we'll talk more about that. But as always, and yes, remember, Chapter 22 homework, Chapter 23 quiz. Make sure that stuff's in by Sunday night. And as always, please remember to stay safe. Wash your hands. Well, definitely wash your hands. That's kind of important these days. Do the right things, and I'll see you all again next time. Appreciate all of you. Have a wonderful, wonderful night. Thank you.